Last week may have marked an important turning point as US inflation figures rocked the markets. Consumer inflation numbers were released late on Wednesday night, with analysts forecasting year-on-year price growth of 3.6%. The actual figure came in at a stonking 4.2%, which saw stocks and bonds sold off for fear of potential rate hikes. US Federal Reserve Chairman Jerome Powell has tried to calm market fears of an inflation breakout, noting that part of the reason why the number was so high is because at this time last year, the number was very low. That is, there is a significant base effect in the yearly figures. While that's true, the month-on-month increase was also much higher than analyst expectations, clearly high enough to concern bond and equity traders. Later in the week, we also saw producer price inflation numbers, which measures the prices paid by firms for the inputs that they buy. This also came in much higher than expected, with prices rising by 0.6% since March and 6.2% since this time last year. That was almost double the level that surveyed economists were forecasting. I did a quick check of some key inputs last week, and there is little wonder that we are now seeing a pickup in the producer inflation figures. Running through a few key examples of recent price action, iron ore, lumber, copper and steel and shipping costs are all at record highs. Gold, beef, grains, crude oil prices, all at historically high levels. We're also seeing upward pressure on wages as border closures restrict the supply of low-cost labour, and generous unemployment benefits in the United States make it comparatively less attractive to work a low-wage job. Of course, the concern here is that prices keep on rising. If that happens, the US Federal Reserve and the RBA may be forced to change their prediction that the spike in inflation won't last. That would mean higher interest rates, which would be bad news for unemployment and for asset prices. Just on interest rates, one of the Aussie major banks made a prediction late last week that Australia would lose its AAA credit rating following Treasurer Josh Frydenberg's big spending budget. The budget recorded the highest deficit as a percentage of GDP since the end of the Second World War, and has forecast another decade at least of deficits. Net debt is expected to peak at $980 billion, but this rests on the somewhat optimistic assumption that the federal government's average borrowing cost will be just 1.6%. 10-year US Treasury bond rates are already higher than that, and if we do see sustained inflation, those rates will continue to go higher. Australian government bonds trade at a higher interest rate than US bonds, and that will especially be the case if we do get a credit rating downgrade. And that's finance.